Mike clears $340,000 a year as a senior VP at a Fortune 500 firm. After federal taxes, state taxes, FICA contributions, and his employer-sponsored benefits package deductions, he nets approximately $198,000. He maxes his 401k, drives a leased BMW 5 Series, owns a $1.20 million mortgage in a suburb of Chicago, and tells himself he's building wealth. Dan cleared $310,000 last year. He left a comparable corporate role 4 years ago, restructured his income through a pass-through S corporation, deploys retained earnings into income-producing assets, and controls his effective tax rate at roughly 19%. His net spendable income exceeds Mike's by $61,000 annually, while working 22 fewer hours per week. The gap between these two men isn't talent, it's architecture. Here's what nobody in your HR orientation packet ever disclosed. The W-2 employment model was not designed to build your wealth. It was designed to optimize tax collection at the source, eliminate financial optionality, and create behavioral dependency through delayed gratification compensation structures. The term golden handcuffs gets used loosely. Executives use it in passing during off-site retreats as if it's a compliment. It isn't. It's a clinical description of a liquidity trap disguised as compensation. The mechanics are deliberate. Restricted stock units vest on a 4-year cliff schedule. Deferred compensation packages are subject to IRC Section 409A, meaning early withdrawal triggers ordinary income tax plus a 20% penalty excise tax, on top of whatever your marginal bracket already costs you. Your pension, if you're fortunate enough to have one, creates what behavioral economists call sunk cost anchoring. You've already mentally spent the future income. Walking away feels like destruction, not liberation. And that psychological weight is precisely the point. Let's get precise about what this costs you over a career arc. Assume you're 34 years old, earning $280,000, with a marginal federal rate of 32% and a state rate of 5.75%, conservative for someone in Virginia or Georgia. Your RSUs vest annually at $40,000 in additional compensation. That $40,000 is taxed as ordinary income at the moment of vesting, not at long-term capital gains rates, which would cap at 15% to 20% for your bracket. That differential, 37% ordinary income versus 20% long-term capital gains, on $40,000 represents $6,800 per vesting event over a standard 10-year mid-career window with consistent RSU grants. That's $68,000 in preventable tax leakage. Not investment losses, not market volatility, pure structural inefficiency baked into the compensation design. And your company's compensation committee knows this. They structured it this way because it works. This is the part that doesn't appear in any financial planning brochure, and it's the part that actually keeps the cage locked. I call it earned dependency syndrome, the psychological condition where high-performance individuals conflate their identity, their social hierarchy, and their sense of financial security so thoroughly with their employer that the idea of optionality produces genuine neurological stress rather than excitement. Here's the clinical reality. A 2019 study published in the Journal of Vocational Behavior found that employees with golden handcuff compensation structures, deferred bonuses, unvested equity, pension accruals, reported higher levels of job dissatisfaction but lower rates of voluntary departure than employees without such structures. Translated, they knew they were trapped, felt it acutely, and stayed anyway. That isn't weakness. That's incentive design, working exactly as intended. The shame most high-earning professionals carry, the quiet, persistent feeling that, despite the title and the compensation, They're one restructuring away from exposure, is not a personal failure. It's a predictable psychological output of a system that requires your fear to function efficiently. At some point, every corporate professional at the $200,000 plus income level has a specific jarring realization. It usually happens during a performance review, a forced RIF, or during the quiet 30 minutes after a bonus announcement that was 40% below expectation. The realization is this: the institution does not have a fiduciary obligation to your financial future. Your manager doesn't. Your CHRO doesn't. The compensation structure is optimized for retention, not for your wealth accumulation. These are not the same objective. In fact, they are often in direct opposition. The W-2 model keeps you liquid enough to maintain lifestyle, illiquid enough to prevent departure, and psychologically invested enough to never seriously audit the math. The actionable shift isn't motivational, it's architectural, and it requires you to execute it with the same precision you'd apply to a P&L restructuring. Establish what's called a management services agreement between yourself and a properly structured S-corporation or single-member LLC, depending on your state's pass-through tax treatment and your specific income composition. This entity does not replace your W-2 employment. It runs parallel to it. You begin routing all consulting income, board advisory fees, speaking engagements, intellectual property licensing, or any 1099-based compensation through this entity. The S-Corp pays you a reasonable salary, a term the IRS defines but does not specify with precision, which is your structural advantage, and the remaining profit passes through at a lower self-employment tax exposure profile. More critically, the entity creates a legitimate business context for deductions that W-2 employees are categorically denied. Post-2017 Tax Cuts and Jobs Act, home office, equipment, professional development, business travel with documented commercial purpose, health insurance premiums deducted above the line, a SEP IRA or solo 401k contribution limit that dwarfs your employer plan ceiling. This is not aggressive tax avoidance. This is the standard operating structure for every partner at a law firm, every independent consultant, and every physician running a professional corporation. The architecture has existed in the IRC for decades. Your employer simply never had an incentive to explain it to you. The entity costs between $800 and $2,500 to properly establish with a CTA and a business attorney. For a $280,000 earner with any ancillary income, the first-year tax differential frequently exceeds $14,000. The ROI on that setup cost is not ambiguous. What you've just mapped is the mechanical infrastructure of the golden handcuffs, the tax design, the vesting architecture, the psychological dependency loop. But the cage has a second lock, and it's one most professionals never locate because it operates beneath the surface of compensation entirely. The loyalty premium you're paying, the discretionary effort, the deferred negotiations, the promotions you didn't push for because you trusted the institution's timeline, that cost has a precise dollar figure attached to it. And it compounds annually in ways that the RSU Fortifure calculation never fully captures. Click the video on your screen right now, and let's pull back the next layer to dissect how your loyalty is costing you $90,000 per year, and exactly which behavioral compliance mechanisms your organization is using to ensure you never run that number yourself.